Imagine working 40 hours a week, waiting for payday, and realizing the government has already intercepted 15% of your paycheck.
Right before it even hits your bank account.
Exactly. You don't get a say in it. Your HR department just gets a notice, and suddenly the money you needed for rent is it's legally gone.
Which is terrifying.
It really is. And for over 2.5 million young professionals who just defaulted on their student loans, that is not some dystopian scenario. That is their current everyday reality.
Yeah.
So, welcome to the deep dive. We are looking at a really compelling piece of source material today. It's called Article 5, Debt, Bankruptcy, and the Collapse of the Financial Safety Net.
Written by Nyambia Emmanuel.
Right.
Yeah.
And it's part of a broader series called the 99% Perspective.
And I have to say, it is a densely researched piece. I mean, the author pulls together hard data from the Federal Reserve, the U.S. courts, the FTC.
Oh, heavy hitters.
Yeah, to paint a very specific picture of the modern economy, and more specifically, what is happening to an entire generation trying to enter it right now.
And our mission for this deep dive is to take all that data and explore how the modern debt crisis is specifically impacting students and young professionals.
Yeah, those early career stages.
Exactly. Now, the author looks at this entirely through what she calls a 99% perspective.
Right.
And we should clarify, our goal today isn't to tell you, if her framework is right or wrong, or take a political side.
No, not at all.
We just want to impartially unpack the hard data she's using and show you how she connects those dots. We want you to fully understand the perspective presented in the text, the underlying financial mechanics at play, and, well, why this matters to the broader economy.
Because regardless of where anyone sits politically or economically, the macroeconomic data presented here is, it's something everyone needs to grapple with.
For sure.
We are looking at a fundamental shift in how early adulthood is financed.
Okay, let's unpack this. We need to set the stage before we even get to the student loan crisis.
Yeah.
Like, what is the baseline financial reality for young people entering the workforce right now?
Well, the baseline reality is a near total depletion of liquid savings.
Oh, wow. Total depletion.
Pretty much. According to the New York Fed data that's cited in the article, total household debt hit $18.8 trillion.
Trillion. With a T.
With a T, yeah, in the fourth quarter of 2025. But the really critical number is that 4.8% of that outstanding debt is in some stage of delinquency.
Right.
The author makes this crucial argument that for millions of young professionals, the traditional emergency fund...
You mean like that 3 to 6 months of living expenses you're supposed to have sitting safely in a savings account?
Exactly. That fund is entirely gone. It has been replaced by credit cards.
And the author points out this isn't happening because people suddenly forgot how to budget.
Yeah.
It's a structural math problem. Wages simply have not kept pace with the fixed costs of rent, groceries, medical bills.
Right. The basics.
So credit cards become the bridge to survive to the end of the month. But let's look at the mechanics of that bridge, because the Federal Reserve's consumer credit data shows revolving credit is increasing, and the average APRs for credit cards that accrue interest hit 21.52%.
In the first quarter of 2026, yeah.
It's 21.52% average?
Yes. And we really need to break down what both of those terms mean in this context, right? Revolving credit isn't like an installment loan for a car.
Where you have a set payment and a clear end date.
Right. It is an open line of debt that rolls over month to month, compounding the interest on whatever balance you carry. And that APR, the annual percentage rate, hitting 21.52% is just staggering.
Why is it that high? Because I remember a few years ago you could find credit cards offering, 12 or 15%.
Oh, absolutely.
So what is driving a 21.52% average?
Well, it is tied directly to the broader economy. When the Federal Reserve raises benchmark interest rates to cool down inflation, credit card companies pass that premium directly to the consumer. Right. Most credit cards have variable rates tied to the prime rate. So when the Fed hikes rates, your cost of borrowing automatically surges.
Wow.
Yeah. So when you are forced to use debt as a safety net, you are suddenly paying a massive federally influenced premium just for your own survival.
It's like using a leaky bucket to bail out a sinking boat.
Yes, that is a great analogy.
You're putting in the work to pay the minimums, but the compounding interest is pushing you backward faster than you can climb.
Exactly.
But I want to push back on this slightly.
Sure.
If I'm a young professional and I know the interest rates are this punishing, why am I not just cutting back on discretionary spending? Like, why not cancel the streaming subscriptions, stop buying coffee out, and aggressively pay down that principal?
What's fascinating here is how the author dismantles that exact argument.
Okay, how so?
The core thesis of this piece is that we are not talking about luxury spending. We aren't talking about vacations or, designer clothes.
Right.
The text argues that the public safety net has collapsed. When affordable housing is scarce, when a young professional faces a sudden medical bill they cannot cover because of high deductibles.
Or when utility costs unexpectedly spike.
Yes, they cannot simply budget their way out of a deficit.
Because if your rent goes up by $400 a month, canceling a $15 streaming service doesn't actually solve the math problem.
No, it really doesn't.
You still need to find $385.
Exactly. And the author lays out a table of financial shocks to illustrate this. A car repair goes on the credit card. A medical bill goes on the credit card.
It's just emergency use for food, gas, and basic bills.
Right. Let's look at the math of compounding interest on something as simple as groceries. Imagine you buy $100 worth of groceries in January because you are short on rent.
Okay.
You put it on a card with a 21.52% APR and only make the minimum payments.
Ouch.
By August, you are still paying for those same groceries, but now they have cost you significantly more.
Right, and that debt is quietly eating a larger and larger share of your future income.
Exactly.
Which means millions of young professionals are carrying this massive compounding burden before they even look at their biggest financial obligation.
Yeah.
So if we follow the narrative thread, you have a young worker surviving month to month on the margins of their credit limit. Then the massive anchor drops right back into their budget.
The resumption of student loan collections.
Exactly.
And this is where the pressure cooker really threatens to blow. The author cites Reuters reporting on the New York Fed's first quarter 2026 data showing that student loan stress is deeply elevated.
Just how bad is it?
Well, the delinquency rate for student loans specifically rose to 10.3%.
Wow. So 1 in 10 borrowers is falling behind.
Yes.
And the data gets much more alarming. There are roughly 2.6 million borrowers who are now more than 120 days behind.
Right.
The text notes those individuals have been referred to the Department of Education's Default Resolution Group, which, that sounds like a customer service department.
It does, right. But the mechanics of what happens next are actually terrifying.
Yeah.
It is the opposite of a benign customer service interaction. When you hit default and get referred to that group, the government has extraordinary collection powers that private lenders simply do not have.
Like what?
They do not need to take you to court to get a judgment. They can initiate administrative wage garnishment.
Taking up to 15% of your disposable pay directly from your employer.
Exactly.
Think about the professional humiliation of that, too.
Yeah.
Your HR department gets a notice that you were in default.
It's awful. And they can also use the Treasury offset program to intercept your tax refunds.
Oh, wow.
It means a direct, forceful reduction of your take-home pay, completely bypassing your own budgeting decisions.
If we look at this through the lens of a 25-year-old just trying to get their footing, that is devastating.
Absolutely.
But this raises a historical contradiction. We were all told that higher education is the ticket to wealth.
Right.
You take out the loans because the degree pays for itself through higher lifetime earnings. But wait, isn't higher education supposed to be the ticket to wealth? How did the ticket itself become the primary barrier to entry for this generation?
If we connect this to the bigger picture, the author argues that student debt is no longer just an education issue. It has metastasized.
Metastasized into what?
It is a housing issue, it's a family planning issue, it's a business formation issue. And the key mechanism here is the debt-to-income ratio, or DTI.
Ah, right. That's the metric banks use to decide if you can handle a new loan, like a mortgage.
Exactly.
It's literally just your monthly debt payments divided by your gross monthly income.
Right. And banks have strict limits, even if you have a decent salary. Let's say you make $5,000 a month.
Okay.
If your mandatory monthly student loan payment is $800 and your credit card minimums are $300, the bank looks at your DTI and determines you are too high risk for a mortgage.
So the student loan dictates your access to future capital.
Yes. It drains the liquid cash needed for a down payment or for starting a family or for putting capital into a small business.
The text explicitly points out that this delays wealth building across the board.
It really does.
The supposed ticket to wealth is actively consuming the wealth before it can even be invested.
And remember the baseline we just established.
Any credit cards.
Right. They are already surviving month to month on 21% APR credit cards.
Yeah.
The resumption of a hundreds of dollars a month student loan payment doesn't just squeeze a tech budget, it completely breaks it.
So let's map out what happens next. If the student loan payment suddenly eats the last $400 in a young professional's bank account, what gets skipped?
Right. Because they still need groceries.
They still need to keep the lights on. For most people, the bill that gets pushed back is the car payment.
Yes.
And that triggers an entirely different, incredibly dangerous cascade.
The section on transportation debt is critical here. For the vast majority of workers in this country, transportation is not an optional luxury.
No, you have to commute.
We do not have robust public transit in most municipalities. You need a car to get to work. But auto loans, insurance premiums, and repairs have become overwhelming.
And if you fall behind on your auto loan, the lender doesn't wait around for years like the Department of Education might.
Nope. They repossess the car.
The mechanism is ruthless. If you lose your car, you cannot get to your job. If you cannot get to your job, you get fired.
Exactly.
The text notes that transportation debt can quickly mutate into a hidden employment crisis.
And as these defaults trigger one another, like the student loan causing the missed credit card payment, which causes the missed auto loan, the nature of the crisis shifts.
How so?
It moves from private budgeting anxiety at the kitchen table to aggressive external pressure.
Here's where it gets really interesting, though. The author points out that debt collection is the exact moment private financial stress becomes a public crisis.
Yes.
It is no longer just you worrying about a spreadsheet.
Yeah.
It is your phone ringing at all hours from unknown numbers. It is the threat of legal action.
Yeah, it's intense.
The text highlights that in 2025, as defaults and student loan collections resumed, the FTC received 471,142 reports related to debt collection.
Nearly 500,000 formal complaints.
That's a huge number.
It really is. And we have to look at the mechanical damage happening in the background during this collections process.
Okay.
A single delinquency on an auto loan or a maxed out credit card fundamentally alters a young professional's credit profile, primarily through their credit utilization ratio.
We should probably define that for everyone. The credit utilization ratio is how much of your available credit you are currently using.
Right.
If you have a credit card with a $10,000 limit and you are carrying a $9,000 balance because you've been living on it, your utilization is at 90%.
And the credit bureaus monitor that ratio constantly. When they see you maxing out your available credit life raft, they categorize you as high risk and immediately drop your credit score.
And a lower credit score, ironically, makes any future borrowing even more expensive. If you have damaged credit, your next car loan isn't going to be offered at 5%. You're going to be offered 15 or 20%.
Yeah.
Your auto insurance premiums might go up because, well, many states allow insurers to use credit scores to set rates.
Right.
You might be required to put down larger security deposits just to rent a basic apartment. The system mathematically penalizes you for having been in financial distress.
It creates an incredibly expensive paradox. The data clearly shows it is significantly more expensive to be poor or even just temporarily struggling than it is to be financially secure.
It's wild to think about it that way.
You are trapped in a cycle of high-interest survival where every setback multiplies the cost of the next necessity.
So we have to zoom out and look at the final destination of this debt cascade that the author maps out. Like, what does this mean for society when an entire generation is caught in this mathematical trap?
Yeah.
The text points to a systemic delay of traditional adulthood milestones.
And the ultimate lagging indicator of all this systemic pressure is bankruptcy.
Right.
The U.S. courts reported that bankruptcy filings increased 11.9% during the 12-month period ending March 31st, 2026.
11.9%.
Yeah. That brought total filings to 591,850.
Almost 600,000 filings. And the author emphasizes that bankruptcy is a lagging indicator because it usually appears only after families have exhausted absolutely every other option.
Right, they try everything else first.
They have bled out for years, struggling through the job loss, the medical bills, the compounding interest rates. It represents the final collapse of a household's private safety net.
And the author draws a direct, undeniable line between this specific debt cascade and the broader wealth gap, particularly the racial and generational wealth gaps.
How does that connect?
Well, we have to look at who is forced into bankruptcy and who avoids it.
Think about a young professional who comes from generational wealth. If they get hit with a surprise $5,000 medical bill or, the transmission blows on their car, what happens?
They call their parents.
Exactly. The parents write a check or loan them the money at 0% interest without running a credit check.
Right.
The emergency is solved in an afternoon. Their credit score remains perfect, their debt-to-income ratio is unaffected, and their upward trajectory remains completely intact.
But contrast that with a young professional from a low-wealth household. That exact same $5,000 emergency is a catastrophic event.
Yeah.
Without the bank of mom and dad to lean on, they are forced to borrow from the commercial market.
They put it on that 21.52% APR credit card.
Exactly. Or they take out a high-yield personal loan. And suddenly, over the next few years, that $5,000 repair turns into $8,000 or $9,000 in actual payments,
Sapping their monthly income and heavily damaging their ability to save.
The text lays this out so clearly. Households with wealth can use savings or familial support.
And households without wealth must borrow from a market designed to profit off their distress.
Yes, and it blocks everything.
So what does this all mean? When we look at this generation of students and young professionals, the People Society expects to be buying houses, starting families, and driving the broader economy forward. What does it mean that their life milestones are put on permanent hold by the collapse of a financial safety net?
This raises an important question, and it's really the core conclusion of the author's 99% perspective.
Okay.
What happens when a society's primary safety net is no longer a public good, but a private, profit-driven enterprise?
That's a heavy thought.
The author argues that high-interest debt has literally become the backup plan for a broken economy. It forces working people to finance their own basic survival.
Wow.
And while they are struggling to do so, the financial systems that collect the compounding interest, the late fees, and the penalties, they continue to grow and profit from that exact struggle.
It completely reframes how we are taught to view debt. Because traditionally, we are taught to view debt as a personal moral failing.
Right, you bought too much stuff.
Exactly. You live beyond your means. But the data in this article paints modern debt as a systemic tax on basic survival.
Yeah.
It is the mandatory price of admission to an economy where wages and the cost of living have completely decoupled.
Viewing it systemically allows you to understand why the author insists this isn't just a localized credit problem.
Right.
You cannot isolate student loans or credit card interest rates from the fundamental reality of how much it costs to simply exist and participate in the modern workforce.
That is the massive takeaway we really want to underline for you listening today. For today's students and young professionals, the nature of debt has fundamentally changed.
It really has.
It is no longer just a temporary tool used to build a bridge to a better future. It is a high-interest tax on basic survival. And this connects directly to you, whoever you are listening to this.
The implications ripple through every layer of the economy.
If you are a young professional currently navigating this landscape yourself, this data validates the immense pressure you are feeling. It is not just in your head, it is not a personal failing, and it is a mathematically proven reality.
Absolutely.
If you are a manager or a business owner employing this generation, you have to understand the sheer financial anxiety your workforce is carrying into the office every single day.
Yes.
And if you are simply a citizen relying on the future economic output of this country, you have to recognize that this hidden crisis threatens the foundation of our entire economy.
Because a generation drowning in 21% interest and student loan wage garnishment cannot consume.
Right. They cannot buy homes,
Yeah.
and they cannot invest at the rates needed to sustain long-term economic growth.
The traditional public safety net has been replaced by compounding interest and bankruptcy risk. That is the stark reality the data presents.
As we wrap up this deep dive, I want to leave you with one final thought to mull over. The text briefly touches on business formation, and it is worth exploring what that really means.
Yeah, that's an interesting angle.
Historically, young people with nothing to lose have been the engines of American innovation. They take massive risks. They start software companies in their garages. They try wild, disruptive ideas because they have the runway to fail.
Right.
But think about the young professionals we just described. If an entire generation is so burdened by student loans and 21% credit card debt just to buy groceries,
Yeah.
if they are terrified of missing an auto loan payment and facing sudden wage garnishment from the government, from the collections process, how can they possibly take a financial risk?
Their risk tolerance is forced to zero. You cannot gamble on a new business idea when your primary focus is simply avoiding collections.
Exactly. If the next great inventors, the next visionary founders, the next local small business owners are too paralyzed by the fear of debt collection to ever start a company, we have to ask ourselves a very hard question.
What is that?
Is the modern debt crisis just hurting young professionals? Or is it actually costing us the future of our economy and the next great era of American innovation?
It's a critical question.
Yeah.
And one that the rising delinquency rates suggest we are running out of time to answer.
Something to really think about as you look at the economy around you. Thank you for joining us on this deep dive. We'll be back next time to unpack another layer of the world we live in. Keep questioning, keep learning, and we will see you then.